Are you tired of feeling like you're pouring your hard-earned money into investments that just aren't paying off? Do you want to learn how to make smarter investment decisions and avoid the pitfalls of overinvesting? Stay tuned for this video, where we'll share tips and strategies to help you take control of your investments and stop overinvesting. Have you ever made an impulsive purchase only to regret it once you got home? Maybe you shelled out $200 for a new pair of Nike sticker NKE, but now that you're staring at them in your closet, they just don't look or feel the same as they did in the store. It's a feeling we all know too well, buyer's remorse. But did you know that investors can feel the same remorse? After hours of deliberation, you finally decide to invest in a stock, only to watch it decline in value shortly after. Suddenly, you're second-guessing your decision and wondering if you should have invested at all. Investor's remorse is a common experience for anyone who's been in the market for any length of time. It's important to recognize this feeling and learn how to manage it so that it doesn't lead to hasty decisions or missed opportunities. When it comes to managing your investment portfolio, it's important to avoid making decisions based solely on the market. Too often, investors make hasty changes to their portfolios in response to emotional reactions to market news, only to later regret those decisions. According to Michelle Brownstein, a vice president at Personal Capital, many cases of investors' remorse stem from emotional decisions rather than rational ones. This emotional response is often triggered by daily commentaries and events that make it difficult to ignore the noise of the market. Comment investing if you would want to see more videos on investing. However, as John Tyers, head of private wealth management at Citizens Bank, suggests, blocking out this market noise is crucial to making better investing decisions. By not being swayed by the ups and downs of the market, investors can avoid making the wrong moves at the wrong time. So how can investors avoid making emotional decisions? According to Rick Edelman, founder of Edelman Financial Services, the best approach is to shift your allocations only when your life circumstances change. After all, your long-term goals and financial needs are unlikely to shift based on daily market fluctuations. By focusing on your own circumstances rather than the market, you can make more rational and strategic decisions about your investment portfolio, ultimately helping you avoid investors' remorse. When it comes to managing your investment portfolio, it's important to ensure that your investment strategy aligns with your risk tolerance. According to Michelle Brownstein of Personal Capital, many instances of investors' remorse can be traced back to a misalignment between risk and investment strategy. For example, if you sold an investment too soon and regret it now, it's likely that you were taking on too much risk. To prevent similar occurrences in the future, Brownstein recommends reallocating your funds into a more moderate portfolio that aligns with your risk tolerance. By having an appropriate investment strategy that aligns with your risk tolerance, you'll be less likely to make knee-jerk decisions in response to market fluctuations that can lead to investors' remorse. As John Tyers, head of private wealth management at Citizens Bank, points out, investing is a long-term play, not a game of chance. So instead of obsessing over short-term results, focus on building a solid plan that can weather any day-to-day volatility. Investors may feel remorse when they don't see immediate results from their investments, but it's important to remember that a portfolio change that reflects your long-term financial goals is what matters. In short, don't sweat the small stuff and stay focused on building a solid investment plan that aligns with your risk tolerance and long-term goals. Investing is not always smooth sailing, and it's common to make mistakes along the way. But as Rick Edelman points out, dwelling on those mistakes can lead to regret, and it's important to focus on making the best possible decisions with the information available at the time. Of course, this doesn't mean ignoring mistakes altogether. Correcting them is crucial to avoid further losses or missed opportunities. One common mistake is trying to time the market or waiting for trigger prices to take action. This approach can exacerbate emotional decision-making and ultimately result in more harm than good. Instead, it's best to make a a plan for getting your portfolio back on track without factoring in short-term market movements. When it comes to fixing mistakes, the approach will depend on the situation. If a stock hasn't moved much, it may be wise to exit it promptly for peace of mind. On the other hand, if the stock has lost value but the company's fundamentals remain strong, it may be worth holding it for a full market cycle. However, if changes in your circumstances mean that the investment is no longer a good fit for your portfolio, it's time to sell. Ultimately, the key is to maintain a long-term focus and make decisions that are in line with your overall financial goals. By doing so, you can avoid the emotional ups and downs of day-to-day market movements and build a portfolio that will weather any storm. Investing can be a daunting task, and sometimes it's okay to admit that you need help. Working with a financial advisor can take the emotion out of decision-making and provide you with a clear path forward. However, it's important to ensure that the advisor you work with is a fiduciary and is legally obligated to act in your best interests. If you've already made a severe financial mistake, seeking guidance may be even more critical. In some cases, the person who sold you the investment may have committed a crime, and filing a lawsuit could be a prudent option. Rick Edelman suggests consulting with the Public Investors Arbitration Bar Association (PIABA), an international association of attorneys who specialize in representing investors in securities industry disputes. They can connect you with a qualified attorney in your area who can guide you through the process. Remember that seeking help is not a sign of weakness, but rather a smart move to protect your financial future. With the right guidance, you can make informed decisions and achieve your long-term financial goals. In conclusion, overinvesting can be a major issue that many investors face, but there are ways to prevent it. By understanding your risk tolerance, diversifying your portfolio, and staying disciplined, you can avoid making impulsive investment decisions that can lead to overinvesting. Additionally, it's important to seek help from a fiduciary advisor when necessary and to take action to correct any mistakes as soon as possible. By following these tips and being mindful of your investment decisions, you can ensure that you're making sound choices that align with your long-term financial goals. Remember, investing is a marathon, not a sprint, and taking the time to make informed decisions can ultimately lead to greater success and stability in the future. So that's it today for you guys. Hope you liked the video. If you liked the video, don't forget to like, share, subscribe, and comment on your investing experience. We hope to see you in our next video. Ciao.